Everyone keeps calling a bubble. The data keeps saying otherwise. Here's the paradox. In a year when warnings about crashes, concentration, and AI hype were everywhere, US stocks quietly delivered one of their strongest broad-based performances in years. The S&P 500 finished up 17.9%. The Nasdaq 100 gained 21%. Not a single S&P sector ended the year in the red. That's not a headline you heard much, but it's a fact buried under noise. And this matters to you, because what you believe about markets shapes when you panic, when you chase, and when you exit. The wrong story at the wrong moment can cost years of compounding. That's not theory. That's how most investors underperform. Now here's where the tension starts. The loudest narrative said the market was dangerously narrow, held hostage by a handful of mega-cap tech names. But inside the data, only 153 stocks in the S&P 500 beat the index average, while 350 lagged. That sounds scary, until you notice what else happened at the same time. Because while people argued about bubbles, something global started shifting. International stocks surged 33% in 2025. The US dollar fell nearly 10%. Capital started moving. So if this wasn't a bubble year, and it wasn't just tech, what exactly was it? The core event looks simple on the surface. US equities had a solid year. Gains spread beyond technology and communications into industrials at plus 19.3%, utilities at 16%, financials at 15%, and healthcare at 14.6%. Even the laggards stayed positive. Real estate was still up 3.1%. Staples gained 3.9%. Discretionary added 6%. No sector went negative. But here's the part most coverage skipped. This wasn't just an American story. After nearly 15 years of US equity dominance, the rest of the world finally started catching up. International stocks rose 33% in 2025. That's not a rounding error. That's a regime-level move. The stated reason matters. A weakening US dollar, down almost 10%, helped fuel that surge. At the same time, global trading partners began repatriating capital driven by dissatisfaction with US trade and security policies. That capital didn't disappear. It moved. Now ask yourself this. If capital is rotating globally, sectors are broadly positive, and earnings are still growing, why are so many people convinced this must end badly? Because the dominant mental model hasn't updated. Many investors are still reacting as if this were 1999. They hear AI, they see big tech stocks, and they assume the same ending is inevitable. But here's where the story reframes. This market isn't behaving like the one people are afraid of. And the proof isn't theoretical. It's visible in a single uncomfortable statistic that undercuts years of bubble warnings. Here's the claim that cuts through most of the panic. Market concentration is not doing what people think it is. The proof is blunt. Only two of the so-called Magnificent Seven outperformed the S&P 500 in 2025. Two, after years of warnings that these seven stocks were propping up the entire market, five of them quietly underperformed the index. That single data point changes the frame. Because if five of the biggest, most watched companies in the world couldn't beat the broader market, then the market is no longer being dragged higher by a tiny elite. It means the other 493 companies are doing more of the work. This isn't opinion, it's arithmetic. If the index is up 17.9% and most of its largest components didn't lead, then breadth is expanding underneath the surface. Now notice what's missing from the bubble narrative. There's no collapse in earnings, there's no sudden multiple explosion, there's no leverage spiral. The story people keep telling requires evidence that simply isn't showing up in the data. And this is where the tension sharpens. Because if the biggest fear for years was concentration, and that concentration is already fading, then the risk investors think they're avoiding may not be the risk that actually matters. This is where the comparison everyone keeps making quietly breaks down. In the late 1990s, markets didn't just rise, they distorted, valuations exploded, debt surged, speculation became the strategy. That's what a true bubble looks like when it's forming in real time. But look at what's actually happening here. Valuations are mostly flat. Not falling, not exploding. Flat. Price to earnings multiples have stayed essentially unchanged for 5 years. Forward PE ratios for core AI companies like Meta, Google, Amazon, and Microsoft have remained stable or even declined. That should feel strange if you're expecting a replay of the dot-com era. Back then, multiples expanded aggressively as reality detached from expectations. Here, prices have moved, but valuations haven't blown out. That means earnings have been doing more of the lifting. And that's not normal bubble behavior. What's becoming normalized instead is something else. A steady drumbeat of this can't last, even as the underlying mechanics remain intact. Flat multiples, growing earnings, broad sector participation, those ingredients don't fit the classic crash script. Now watch how this escalates, because bubbles don't usually form without fuel. And the most dangerous fuel isn't optimism, it's leverage. Here's the evidence that makes the bubble argument even harder to sustain. Bubbles are almost always powered by debt, excessive borrowing, accelerating leverage, people stretching balance sheets because they believe prices can only go one direction. But that's not what the data shows. Debt growth has been muted, essentially flat for 5 years. In 2025, debt rose just 9%. Now contrast that with the period everyone keeps referencing. In the late 1990s, debt didn't creep higher, it exploded. Triple-digit growth, plus 111%, plus 111%, triple-digit growth, plus 187% in consecutive years. That's what speculative mania looks like when you chart it. Here's the contradiction. People are calling this a bubble while the classic bubble accelerants are missing. No leverage surge, no valuation blowout, no debt spiral, yet the warnings keep getting louder. And this is the line that permanently reframes the story. A market can be expensive without being a bubble. Those two words are not interchangeable, no matter how often they're used that way. The pressure point is earnings. And this is where the story accelerates fast. Earnings have been growing at a robust pace over the past few years. Not hypothetical earnings, not projected someday maybe profits, actual results showing up quarter after quarter. If you could only look at one data point to explain market performance, this would be it. Now stack what happened next. First, the AI boom didn't stall corporate profits. Second, it didn't hollow out existing businesses the way many predicted. Third, companies integrated AI instead of being disrupted by it. Take one concrete example. Google was repeatedly described as an AI casualty. The claim was that AI would kill its core search business. Instead, Google integrated AI into search and its stock rose 65% in 2025. That didn't happen in a vacuum, it happened alongside earnings growth. Now here's the mini crisis people missed. While headlines focused on fear, companies were quietly executing. While social media argued about bubbles, balance sheets improved. While retail investors debated crashes, earnings kept compounding. This is where the story flips. Because the longer earnings support prices, the harder it becomes for a collapse narrative to trigger on its own. Fear needs a catalyst. So far, it hasn't found one. Now pull this out of the market and into your own life. Because the real impact isn't whether the S&P 500 is up 17.9% or international stocks gained 33%. The impact is how information shapes your behavior. When you're flooded with inaccurate data, baseless opinions, and misleading commentary, the damage doesn't show up immediately. It shows up years later. This is the part that hits ordinary investors. You hear constant warnings, you feel pressure to act, You hesitate to stay invested. You get shaken out of positions, not because the fundamentals broke, but because the noise got louder than the evidence. The content itself admits this risk. Much of what dominates financial media is not just unhelpful. Some of it is out of context. Some of it is simply wrong. And the result is poor investment outcomes for the people consuming it. Notice what this means in practice. While earnings were growing and sectors were broadly positive, many investors sat on the sidelines waiting for a crash that never came. Others jumped in and out, paying the hidden tax of bad timing. This isn't ideological, it's mechanical. Compounding only works if you stay in the system long enough for it to do its job. Here's the systemic insight that changes how all of this fits together. Markets don't move on truth alone, they move on incentives, attention, and fear. And the incentive structure around financial information is badly distorted. Calm, data-driven analysis compounds quietly. Panic spreads fast and gets rewarded immediately. That's the mechanism at work. Misinformation doesn't dominate because it's accurate. It dominates because it's emotionally efficient. It triggers action. It keeps people watching. And it rarely gets penalized when it's wrong. Meanwhile, the process described here is the opposite. Start with roughly 100 ideas. Cut them down to 30 charts. Force discipline. Curate evidence. Remove the noise. That's not exciting, but it's how you avoid reacting to shadows instead of signals. Here's the unsettling insight. Most investors don't lose because markets collapse. They lose because they are talked out of staying invested before the math can work. Fear doesn't need to be correct. It only needs to be loud at the wrong moment. There are two paths forward from here, and neither is guaranteed. In the first path, the current dynamics continue. Earnings keep growing, debt stays contained, valuations remain anchored, capital continues rotating globally as the dollar fluctuates and international markets catch up. In that scenario, markets don't collapse, they frustrate, they grind higher unevenly while people keep waiting for a dramatic ending that never quite arrives. In the second path, something external forces a break. Not a meme stock implosion, not an AI panic, something structural, a shock to earnings, a sudden policy shift that reverses capital flows, a disruption that actually shows up in the data instead of just the commentary. Notice the difference. One path is slow and boring. The other requires a catalyst that isn't visible yet. Here's the insight that ties the entire story together. This wasn't a year defined by a bubble. It was a year defined by a myth. The myth that every strong market must be fragile. The myth that AI automatically means speculation. The myth that concentration guarantees collapse. When you strip the noise away, the picture looks very different. Broad gains across sectors. Only 2 of the Magnificent 7 outperforming the index. Flat valuations. Modest debt growth. Earnings doing the real work. International markets finally catching up as capital rotates. Reframe it in one sentence. The danger wasn't that markets were lying to investors. It was that investors were being told the wrong story about what they were seeing. One day this bull market will end. That's inevitable. But most people won't be hurt by the end. They'll be hurt by leaving too early. If you want to understand what actually signals the turning point, not the myths that dominate headlines, stay with this channel. The next